So, welcome to this discussion or presentation on new market regime. We've been getting these words from a lot of people, including us. You've been hearing it that this is a new market regime. Things have changed. Things have moved on. What are these things? What is the regime change in the market? Market is always dynamic, and any regime change is very imminent. And when we define a market regime, it's basically the behavior of the market over a longer period with some constant parameters. When those constant parameters end up changing, and we're going to discuss about the change, the behavior will change, and these behaviors will bring in some new constant parameters, which will result into a new regime. So what was constant earlier is not constant right now, and there are some other constant factors that are there. The change in the market behavior has a variety of reasons. Some are permanent, some are temporary, and it's very difficult to identify those. And that's where an exercise goes into identifying the, what are the changes and why are these changes, where have they come from, and eventually it's understanding basis some things that you see in the market, but eventually, any new regime change is very difficult to identify while you're staying in the market yourself or while you're being in the market yourself. So even for this exercise, I had to stop looking at the daily M2M, for 15, 20, 30 days before I could, try and see it from a different way altogether. When you do look into M2Ms, when you do look into your fluctuations, you end up assuming that the market is moving in a certain way, or assuming that by this point your P&L is at maximum, so this is the new regime. So new regime doesn't mean that instead of closing at 3 o'clock, we are closing at 2:45 just because there's a 15-minute volatility. Or new regime doesn't really mean that because certain days certain TSL worked, we are moving into that TSL. Right, so a regime change is a very, very strong change that you would see in the market, and that's what we are trying to define. And that you can't see while you are in the market. At the same time, they are difficult for algos or quants because past data is quite limited in here. While, when we are trying to trade as algo traders, we end up having, taking a lot of decision on the past data. Here, past data is limited. It's more about the forward testing, which requires a lot of patience from us as well as users at times, because you might see a wonderful opening in a strategy which works well in the current market, but you have to also test it in forward, because it should not be that it is just working for a period of time and then doesn't have a long-term relation to it. And this also goes in when you're trying to create a strategy, right? Earlier, we used to define our SLs, and we need to optimize our SLs and targets, which will not work in, with limited data that is there on the new regime. So what has changed? I think, I don't think many people would argue with what I'm trying to say here or share here. Volatility is more, premiums are less, price action is literally screwed on shorter time frame, not on higher time frame. Momentum is very vicious and it runs for a very short time. So there's more chances of a short-term momentum rather than a longer-term momentum. And that's something which has defined the last 6, 7, 9 months into it. Overnight trends are very highly unpredictable. They used to be very strong. And if you close on day's high, you would have a gap up certainly. But that's something that has gone away from the market because there's so much exposure to this that has already happened, and these trends have become very unpredictable. SL hunting is now a norm, and reversals are way too common. So there's been, again, I don't need to say much about it. We have all seen how reversals have been, how brutal they have been, how sharp they have been. And that's again what has changed in the market. What is the reason for the change? Volatility is increasing with increased participation. and premiums are not going up because there are too many sellers. This is one of the lines that I'd spoken about earlier in drawdown discussion that I had. Volatility has been, increasing with more people that are entering. The more the people are entering, more people are trying to sell options. So there's enough demand, enough supply of selling options, and there's less demand of buying options. And when there's enough supply, what happens is the prices go down. So that's what is happening with the premiums as well. So volatility is not a large swing. It is actually larger than the premium that is allowed. So it's not like, I mean, someone would say, just 200-point movement. What is wrong with that? Bank Nifty move like that. It's just that when your straddle premium is less than 50, and then you have a 200-point premium, a 200-point swing, it doesn't really make sense, because mathematically, what a straddle premium defines is the range in which the market should perform. But volatility is not measuring that. I mean, that's the whole essence of it, and that's where a lot of strategies are struggling, because they work with this thing. When you're saying 30% SL, 40%, 50% SL, what you're trying to say is that the premium that you have sold is a reflective of the market volatility, or what range the market should go in. But when it is not, then that 30%, 40%, 50%, whatever SL you got is gonna, make your life miserable. As the volatility increases, the more SLs are hit. Again, as I said, just because your range of the market is higher than what premium allows, it'll move in both the directions. And eventually what will also happen is the market will reverse. So this is a chicken and egg situation. More the reversals we have, more the impact on the price action on the smaller duration. So when we talk about why the price action is crude, it's again coming from volatility, it's coming from the premium swings, and it's coming from the SL that are hit. The more the reversals are there, the more there will be impact on price action. It might become such a big resistance on a smaller time frame, but then suddenly, or such a big support on a smaller time frame, then suddenly it just breaks it down. And this is also the reason why many indicators are not working as they were working before. So you have to basically try and look into something which is working, and something which is so some of the indicators which are let's say lower sensitivity or lower time frame lower time frame indicators will not work. Lower sensitivity indicators will work much better. And then another additional thing that has happened is that there are so many expiries now. So there's a Fed Nifty expiry, there's a mid cap expiry, there is talk of doing a Sensex expiry on Friday. So this is all going to cause further movements, because eventually all these indexes are made up of stocks. When indexes move, stocks also move. Stocks move, indexes also move. So then we will have even more wilder movements. And then eventually one, let's say, elephant in the room, there is too much concentration on specific types of strategies, which is basically selling weekly straddles. Even if it is manually or via systematic trading and so many other platforms coming in, it is definitely one of the things that is affecting the market and is the major reason for the change of the market regime, because there's so many people selling straddles. There's so much concentration on ATM strikes and on these fixed SLs, percentage SLs, that the market, if you expect the market to not hit your SLs, you are actually living in a paradise which is not there. It doesn't exist, that kind of a paradise. So we have to also embrace this reason. So how do we define this new regime now? Because we have talked about what are the changes and what specific changes happened. Now let's define this new regime. Lower premiums are the new norm. Doesn't mean that I'm not saying that a premium low premium doesn't mean that straddle premium will never go to 1,000 or for Bank Nifty, or 500 or 600 for Nifty. It would go, but at that time the volatility will be much higher than the premium allows. And this is part of the new regime. Even if right now someone says VIX is 11, the behavior of the market is not of VIX 11. volatility has to be handled with lower trades. So one of the things that you can always do when there's too much volatility is to take lesser trades. The moment you take lesser trades, the lesser chances of you getting impacted by the volatility, as well as impact costs related to slippage and the trading costs. So you have to make strategies which will trade less. Doesn't mean that scalper you limit the entries to 2 per day. That will not solve the issue. You have to actually have strategies which will embrace this volatility and make sure that it takes additional confirmations before quitting or exiting the trade or switching to the new trade. Another thing is that traditional percentage-based strategies, percentage SL-based strategies will be less effective and they will give low returns. I think most of the people have already seen them that the returns have gone down to 2%, 3%, or in fact much lower than that as well. Given the volatility that has been there, the returns have become much, much lower. Not all expiries will be easy. So there was one other things that people used to do, that we will only trade on expiries. Now expiries have become massively difficult. 1 out of 3 expiries, 1 out of 4 expiries is rather easy. The rest of the 3 expiries have got some sort of a gamma move, some sort of a wild move that happens, and or some sort of a initial volatility that happens and takes out most of the SL. There is just too much crowding on expiries these days. In fact, for that matter, RBI governor has also started speaking on expiries these days, which is crazy and something that really affects expiry traders. So nothing is going towards expiry traders these days. Yeah, and again, one of the things that we talked about earlier, momentum could be very short-lived. So that has to be there in the strategies which we create for the new regime. And then last but not the least, because there's so much reversals and reversals and SL hits, you need to have something which is a contra in the behavior, which will blossom and which will work better, because the more the crowding that happens, it's not that the crowding is going to go away. There was a time where I felt, people will relent and not trade, but more the platforms are coming in, it's actually people are going to trade more. It's more like, when people say that, okay, now SCT has increased, so people will trade less. It's actually the effect is other way around. When governments increase the tax on tobacco, actually the tobacco consumption, or basically the cigarette consumption, goes up. I'm sure many of you have seen this analogy. So if that is the thing, how we will define, how will we measure the algo strategies in the new regime? And this is basically not from a day-to-day measurement. I'll come on to the day-to-day measurement with examples. But what I'm trying to say is, what are the kind of strategies that we will look into? So instead of just looking at historical win rates, we'll have to, and returns, we'll have to look into last 6 months and 1 year ROI as a qualifying parameter. It doesn't mean that we'll not see, backtest for 4-5 years. It's just that the last 6 months to 1 year becomes an important point where you have to see if the strategy has still managed to perform in a similar way or has outperformed. If it is underperformed, that is not the strategy for the new regime. If it has performed significantly, okay, still you can consider it. But if a strategy is outperforming in the last 6 months to 1 year, while in the last 4-5 years it was performing decently, I think that strategy is a winner, and that should be part of a portfolio always. Lower trades will have an edge because, again, the volatility is much. So slippage, transaction costs, everything will be controlled by lower trade strategies, which would mean, going to monthly straddles, for example. At the same time, hedge strategies are the need with extremely low premium, primarily because, one, it makes more sense to buy hedges when the premiums are low. At the same time, another critical part is when your premiums are low, at the same time, when you have a wild move on a certain day, your OTMs, premiums can actually help you gain some of the make some of the gains from your when your strategies are failing. So that's one part that can happen. Primarily, again, one thing is that once you have hedge strategies, your risk reward changes completely. And that also is something that is important for this regime, because you are anyways taking a higher risk and your rewards have lowered with the similar kind of strategies. So how do you increase your rewards? That is something that is important here. Rolling returns are important than just 1 month return or previous month return. So we used to look into 1 month return or previous month return and say, okay, this is fine, the strategy is doing okay. But it is important to see the rolling returns. I'll explain this concept, much in detail when we go on some of the next slides. Correlation data will need more, correlation analysis will need more data. So right now, we had a correlation sheet and we were updating it regularly. But currently, for the new regime strategies, we need to have, more data for correlation, because they are completely different, from how how the other strategies work. So we will need some more data on correlation, and once that is there, that we'll be sharing. As I also mentioned, the risk reward has skewed in favor of hedge strategies. More importantly, intraday strategies. So intraday hedge strategies are doing much better in terms of returns as compared to positional directional strategies as well. So that's been one of the things that has occurred in this market, because if overnight trends are not something that you can trust on, then intraday becomes much important. So what is the preparedness for the new regime? Where are we on the new regime? So many of our strategies have already been updated to the new regime. When we have been conducting this exercise to define the new regime, we have seen a lot of data and a lot of things that have already been done to update this. So we've got a strategy like TIDM, which is a volatility special strategy. It was launched in September, I think, September, October, and it has already been the strategy which has worked well on the volatility, because it takes adjustments quite quickly. As we said, the momentum is quite short, right? So that you need faster adjustment in that case. So that's what TIDM tries to do. In TDSP, we have updated the weight logic to work better in the current volatility. So it had a weight logic which was not working in the current volatility, and we've updated that to work better. So last month was a first full month of that updated logic. It had a fantastic 5.6% return with less than 410 trades, which is quite significant for TDSP kind of a strategy, which is always paired. So it used to have about 700, 800 trades. So it has come down to 400 trades. This is a major improvement in the strategy. And also it has worked well in the current volatility, beating any other strategy that we've got on the intraday non-directionals. TDD has handled the volatility quite well. There have been no changes in it, but we will be monitoring further if there needs to be any change. So now we talk about 3-4 new strategies that we've launched. So BTW has been there for 3-4 months. It's an aggressive semi-directional strategy. It's traditional in that nature, but it takes adjustment quite fast, and that is where the aggressiveness comes in. TCS is a contra strategy on both the indexes. It is moderately aggressive, so it will not be running naked for quite long time. It will try and find out when it should be back into a straddle or a triangle. So that's what differentiates TCS as a contra strategy. While TCB is an aggressive contra strategy, which basically will run naked till the point that it doesn't hit a particular SL or particular indicator. It will run naked as well if it takes a contra position. So contra is nothing but when you're squaring off a winning leg rather than squaring off a losing leg. So that's what TCS and TCB define. While BTW is a traditional one, it will square off the losing leg first, while it will square off the winning leg later. ZOS has been again doing extremely well in handling the volatility and capturing overnight gains. Has been doing a rolling return of 3% per month with probably less than 100 trades, because it also takes hedges on certain days. TDS FinNifty again updated to the wait and trade logic to work better in the current volatility. Although it was already working better, FinNifty as a instrument has been doing better than Nifty and Bank Nifty. But we wanted to make sure that the TDS logic remains the same across all the indexes that we are trading it. So we have updated it to the new weight and trade logic. Again, this has also benefited from the number of trades reduction. So it was around 300 trades. Now it should be around 220 trades in TDS with Nifty. So there are some strategies that we are monitoring, and we'll be looking into some of the changes that we are doing. Of course, there are some changes that we have already been testing. So I'm not going to talk about many of the changes that we've been testing, but the strategies like TQS, ZapPro, GMP, JFD, ZIP, and GOS is something that we are monitoring right now. In addition, what we are going to do is we will be making a different matrix of correlation. We will be sharing that with you guys very soon. We will also choose strategies that have better cost to turnover ratio and replace existing strategies with it. We'll be choosing strategies which have a alpha and standard deviation of returns and the reduction of impact cost. Core strategies will still remain the same: 5 to 6 into non and semi-directional, and 4 into directionals. So we will not have we'll not be adding more strategies. We'll be replacing the less effective strategies or correlated strategies out of the portfolio and putting in the new regime strategies that are there. We'll also be having more reliance on forward testing, a 3-month forward testing or a 1.5-month live testing is what we will be concentrating on versus the back testing. Even if the back testing results are fantastic, we are not going to be sharing it with people because it is going to give an unrealistic expectation while we know that we are getting into a new regime which might have an impact. And that's where the measurement of how the returns are happening is very, very important. So this is how we have redesigned our dashboard. This because this has the data or it's been updated till today and there's no return here for any of the strategies today. So this is what is blank. But if you can see, we are measuring DD from peak every day for each and every strategy, so that whenever someone is joining a strategy, they know that how much DD the strategy has gone in. We're also measuring the last 21-day win rate against the historic win rate. So if you see green here, that means it is doing better than the historic win rate. We're also measuring the rolling monthly ROI. So now what is this rolling monthly ROI? Is basically we're doing an average daily return for last 63 days, which is basically 3 working months. We multiply it by 21 days to convert into a month and divide it by the capital of the strategy. What this means is that if we are in the mid of the month as well, it is considering not only this month's return, but previous 2.5 months return. And that helps because you might have a time when a strategy is doing fantastic, but last, 2.5 months, it was not doing fantastic, or vice versa. So it's a strategy that is doing quite good. So for example, TCV did not do well last month. It showing lower returns, but someone, if he looks into the data for February and March, they will see about 8%, 9% return, and they will start having that expectation. So what we are doing is we are trying to tone down this expectation already at this rolling returns number, right? So people have toned down expectations or more realistic expectation with the rolling return number, because you might see 1 month and you say, okay, this is fantastic, but you have to also look into the other month and where this return comes from. And this is how we will be, doing more of our analysis these days. We'll be also adding some more things, which is risk reward and number of trades that will help, people to understand the cost of the strategies, the risk that they are taking as well. So in a sense, what we are trying to do is not only that we are trying to, look into the data from return point of view, from correlation point of view. We'll also be looking into it from a historic win rate point of view, from a last 21-day win rate point of view, covering each and every possible situation which might, give some people the wrong idea or avoid you missing out on a strategy which is doing great. So it's both. So if I'm saying that there's a strategy which is doing great, which is higher, let's say win rate, what is the return in this. Although TDSP had a 5.6% return because March was a flat month for it and February was still decent at 4, it has got a rolling return of 2%. So it's not going to forget. We are not going to forget our past DDs. We are not going to forget our past performance. We are going to talk to you about our rolling performance. If we are expecting people to stay with a strategy for a few months, we have to also share a data for a few months. So that's how we're going to go about it. And I think, again, as I've mentioned, when you see a higher return, a higher percentage, you also have to be cautious that, it's also at a peak equity high as well. If there's a strategy like TDSP, you can see it's not at peak DD. So you are actually still, good to deploy this. You're still good to deploy BTW. TCS might be slightly risky, but it's not, the difference is not too much as well. So you can deploy. Again, same case goes for TIDM. You can go ahead with this. ZOS might be a bit risky to deploy because it has done quite well for last 3 months. So there is a possibility that ZOS can give some losses, in the process. And once it is in DD, then you can look into deploying it. Same is the case that goes for GFT. It's better than the historical win rate, and it's still in the drawdown, but it's something that can be expected to go out of drawdown. So what are the strategies for new regime that we are testing? So we have got 3 positional strategies, and then there are some other things that we are doing. So there's a Zeta hybrid position, which is a strategy that already been used by 21 people now. It's a hybrid semi-directional strategy, which has overnight hedges for protection. So it will basically be a straddle, overnight straddle, or a spread in a direction. And unlike the zip or any other direction strategies that we've got, it takes additional confirmations before it takes that strike. So people who have used this strategy have found out it to be very, very stable in terms of P&L fluctuations, and again has less than 180 trades per month, including the hedges that are there. So that's about it for this one. We also have a positional monthly straddle. It's a combination of a long and short straddle. So it's depending upon some conditions. It might take a long straddle. Again, this is quite a new kind of a strategy. In lower premium regime, it actually makes sense to go do a long straddle as well. It also has hedges for overnight protection, and something that again has been doing well. In the last week it gave about 2% return as well. Took long straddle as well. Closed it at about a 0.5% return. 0.5% on the long straddle. Capital required is less, but on the higher capital it gave 0.5%. So on actual capital, about 2%. We also are going to do a monthly directional spread. That's something that is coming as well, which will be at a higher time frame. Other strategies that we are working on is positional triangle and a contra-directional strategy. Right now, only ZHP is up for available for subscription. PMS is second in line. We'll be testing it for another 2 to 3 weeks more, and basis our testing, we'll be releasing it. ZMP and other strategies are not yet available for testing. Then we have got some intraday strategies. ATBS is the anti-time-based straddle. So now everyone is clear that time-based straddles are not working as much. So, anytime a fixed entry time, fixed exit time is not working. So what is this ATBS is? It works on some parameters whereby it will not enter at a fixed time. It will actually be working more like a, random time entry. So not random for everyone. Random basis the day and the data that it takes. So basis the data, it might take an entry at 9:16, or it might even take an entry at 10:30, or it might close at 2:15, or it might close at 2:45 as well. So that's why it's called anti-time based straddle. It may go semi-directional if needed, but most of the times it will be a paired strategy as well. Then we have a directional tandem intraday. Now this is a different kind of a directional strategy. In some of the direction strategies, you would see that we will be taking different directions for Nifty and Bank Nifty. this will always take the same direction. It is actually calculating the move for both the indices together and then eventually deciding what to do. So this is a different kind of intraday directional strategy. It's although it's semi-directional, but it's actually a directional strategy. I would put it this way, because it hardly goes semi-directional, on certain days, but it'll be mostly directional only. Then we have got intraday contra buying strategy. So when, again, as I said, when you have a contra strategy, buying around a resistance, buying a call or put along the resistance so that you can gain from the down move. That's what we've been working on. There is another FinNifty version of TIDM which has been doing quite good, and there's another intraday strategy with quite a unique logic. We are not going to talk about the logic right now. It's under testing as well. So there are a few intraday strategies. We are also going to work on a buying scalper, which will be quite different as well. Again, trying to capture the short-term momentum that we've got. So that's what we are going to do. I hope this helped you in understanding what we are doing for the new regime and, how this new regime is different. I'm ready to take any questions if you have. You can raise your hands and speak. Ankur, you can unmute yourself.
Hey Vishal, thanks a lot for this detailed description. It really helps. My question is, earlier it used to be 5 strategies which we used to deploy for a 15 to 25 lakh capital. Now I can see there are certain new interesting strategies are coming up. So what is your preferred number in terms of total strategy one should have if the capital size is say 15 to in between 15 to 25 lakhs?
It will be the same, Ankur. We will not be introducing 5 to 6. We are not going to be so this is what is going to happen. We are not going to be adding new strategies. We are going to be replacing some of the strategies. So we've got 2 contra strategies. We have got let's say TIDM and TDD, which are traditional kind of strategies, 2 of them. So we will eventually replace into this. DTI might become one of the directional strategies that we have got, right? So idea would be to replace existing strategies. We'll still keep the same in the core, and we'll still recommend people to do 4 to 5 strategies only, not beyond that.
Okay, thank you.
Because we are eventually talking about reducing trade cost.
Thanks.
Yeah. Anyone else? Any questions? You have to raise your hands and I'll allow you to speak. Some of you are already allowed, so you can actually unmute yourself and speak. Hi, Udit. You can unmute yourself. Yeah, Pritesh bhai, just 1 minute. Let Pritesh speak first.
Yep, sure.
Pritesh bhai. Yeah, Vishalji, I wanted to ask what's the difference between DTI and PMS? I know it is intraday strategy, but both would be working for the same. That is on monthly basis, and this will be on an intraday basis.
Yeah, so PMS is a long straddle or a short straddle on monthly contract, right?
Okay.
While DTI is going to be a weekly intraday strategy. So basically, it will let's say this week it will only trade for this week expiry options. On the expiry day of this week, it will trade next week expiry. And it is going to take a direction.
You would have observed the returns of DTI and PMS for live testing. Can you put it in your group so that it can be?
Yeah, I'll share some of the returns that we got. I'll share that. But in the live testing, I saw some of the things, right? So one of the things that is there with ZHP and PMS is what we are trying to do is this positional strategies to have a smoother P&L swing, so that a lot of people who are hesitant of positional strategies could use it, because one, you have let's say smoother P&L fluctuation, as well as it gives a comfort that you're not losing your P&L onto that massively.
ZIP be replaced by ZHP? Is that a plan?
Yeah, there is a plan to do something like that. So ZIP, we are also working on certain things that. So ZIP has the advantage that it would only get into trade when there is a momentum. Now, when the momentum is screwed, so then we have to work on something else. So Bank Nifty is still doing okay. Bank Nifty average returns are still 7% for the last 3 months. The problem is on the Nifty part. So we are looking at something on this. I think in a couple of weeks you will have some decision on ZIP as well.
Okay, thank you.
Udit?
Yeah. Hi, Vishal. Thanks for the good overview. So my question is regarding something like GMP or any other positional buying with so many reversal and stop loss hunting. What do you see the future of like positional buying type of strategies?
So GMP, there is a very interesting approach that we have done in testing. The interesting approach being that, so we had a GMP initially which had an intraday leg as well. And intraday momentum at the time was not good, and we took a decision to move it out. And we've been testing a GMP version with intraday leg as well, to actually capitalize on the intraday momentum. And that's seemingly doing well. So the GMP will have to have things to capture the momentum at different time frames in a different way altogether. Something similar to what we were doing earlier.
Okay. So during the day, you are saying there is still a possibility of capturing momentum. It just overnight the reversals have become bigger
definitely
for some positional buying.
Yeah, definitely. So overnight reversals are still a worry, but intraday we have looked into something, and that should work. And there is let's say a new regime version of GMP that is already there with us and under testing.
Thank you.
Hi, Vishal.
Hi, Dhananjay. How are you?
I'm good. Shall I continue, or Shashwat is there?
Yes. You can continue.
What I feel, Vishal, the nowadays the market is behaving and the momentum is very much short. Even the positions are getting hunted badly. So, what exactly have you thought about this kind of thing? And another question is that, have you ever think about the scalping of kind of a strategy which really enter and go fast away by taking their profits, and if it is stop loss also still okay?
So on directional scalping, we have tried many things, but eventually what happens is scalping will increase the cost and will make the, let's say, the cost of operating very similar to a directional scalping will make the cost of operating very similar to an intraday scalping strategy. So it doesn't make any sense to do it. Actually, most of the position strategies we gain from continuing in the trend. So the approach that would work or should work is the one that we are trying with ZHP, whereby if the momentum doesn't seem to be strong enough, you go for a straddle. Okay. Eat the decay. And of course, this is not same straddle as same percentage straddle as a lot of us have seen. It's a different kind of a straddle. So it looks into different parameters to before it tries to switch or move from a straddle to a spread. So it will actually one of the things is this. Another thing is to, like in the current ZIP only, if we put up something like a risk reward into that, which is limiting the gains per entry, limiting the losses per entry, and that's something that is being tested as well.
Do you think that it might be a study for you, or you might have reviewed earlier also? Likewise, we are shifting to a new regime, or we thinking that something should be changed in the strategies so that it could handle the volatility. So, does other strategy makers also might have seen or shifted any changes in their strategies? Have you just encountered anything changes?
You meaning other strategy makers?
Yeah. You might have studied the competitor as well.
So I understand that from a lot of people is that many of them have all stopped buying option buying completely. Some of them have stopped directional selling completely. That's been the fate of directionals and buying strategies. So see, eventually any regime cannot take away from the fact that the market will break out, market will break down. And it's just that the volatility period that we had, we would avoid via our indicators in ZIP. That may need updating, and that's something that we are looking at. Or the risk reward may need fixing. That's what we are trying to work out. Because eventually, when you're, if you would have seen the presentation as well, it's all about your volatility and managing the volatility with either reduced costs, reduced exposure to the market, or managing with a different month altogether. So something like a ZMP would be more like a ZIP kind of a strategy still, but it will be on a monthly regime, monthly count, the contract. So that will not be. So if there is a counter movement against it, it will not make it affected as much as a weekly strategy will get affected. So that's one approach that we are also taking, and that's what some of the people have also done. They have moved into monthly contracts.
Yes. Yeah. Thank you, Vishal.
You're welcome. Anyone else would raise their hands? Ashwat, can you unmute yourself?
Yeah, am I audible?
Yeah.
Actually, I wanted to know the future of the current versions of GMP and ZIP. I already heard some previous members, I think, with a similar question, but I wanted to know that should I continue with the same version for the moment, or should I wait for the new versions of the GMP and ZIP?
So I'll put it this way. It's not that I am doing anything different. I'm continuing with the current versions because there is a tendency that happens with directionals that they will have longer period of drawdown. But what is worrying me and pushing me on this, change of the, strategies is that the drawdowns have become too frequent. And once the drawdown have become too frequent and we have understood that the regime has changed, we have to work on it. And that's what we are trying to do. That doesn't mean that the current strategies will not work. They will work. They will have lower returns than previously. So if you want, if it doesn't give you comfort, then you can stop GMP. You can use GFD for that matter, which has been working well. And that's where the data is for, to see what is working and what is not working. And then choose that version. And then once we come up with a new version, we test it, then you can move to GMP as well.
Okay. Actually, I was using GFD also in the past, but unfortunately, for some reason, GFD hasn't given me any returns at all. Even from, I think I started it from the first week of March. I'm not really sure that if it has to do with slippages or not, because your live auto data also, you guys, I think, still have some kind of returns, but I have negative returns. That is why I had to stop GFD. in GMP only recently I went negative in returns. But I wanted to know that if due to this regime change that you guys are talking about, any change that you guys are thinking of making in the current GMP also, or maybe you are thinking of parking it. I just want to know an idea behind it, because then if like it won't be supported anymore, then I
No,
might as
it's
well
not.
park it. And
So
yeah,
anything that is there in the core portfolio, Shashwat, is being supported. In fact, there are strategies outside the core portfolio as well that we are supporting. What we will be doing with GMP is definitely trying to improve on this momentum catching in intraday.
okay,
But a buying strategy not being able to catch momentum is the fatal part.
right.
So that's what we want to fix it, because these days intraday momentum has been very, very strong. So it's not
Yeah,
going to
so
be like we'll be going to the previous version of GMP, which was just doing the same thing and was not let's say was very volatile. It will be less volatile with trying to capture the intraday momentum.
okay. Yeah, so I just want to clarify one thing. The changes in GMP, will these changes come in like in a new version altogether, or will
No, the current version only.
some change? Okay, okay. So, no, so as in, I will not have to subscribe to a new strategy to.
No, no, no.
Uh, oh, okay. So
So
it will be made
ZHP.
available in the current change, the current version only.
So ZHP is a completely different strategy because the way it actually trades. So it's not a spread anymore, and that's the reason why it
Right.
was put into a different strategy. So if you see as well, we have done a current regime update. We are very we are one of those creators will not be updating their logic just like that. So we have updated TDSP after quite a long time, just because there was a filter that we added into it to work better in the current volatility, and that's how we are going about it. The same thing will happen with GMP or ZIP or GFD or ZAP whenever we do the changes, and that will definitely happen quite soon. You will get a lot of information on this in the coming days.
Okay, and just one more question, though this is probably no one knows this, but given your experience seeing the market, how long do you think, like for say in directionals, obviously when drawdown comes, they last for a fairly longer bit than say for non-direction. So how long do you think this drawdown may last in current versions of all the already the option buying strategy, GMP, GFD, and other such strategies? Anything that comes to your mind that maybe it may last for 1-2 months more, or something that you guys are able to see by looking at the markets and other strategy logic?
So I think if I want to say something about the current regime, probably this is one of the most important regime changes for us in the Indian market. This regime change is actually moving Indian markets towards efficiency.
Oh,
When
okay.
more and more participants are there, more and more systematic trading is happening, the market will become more efficient. When the market becomes more efficient, a lot of simple things will not work. A lot of known things will not work. So one of the things that if you also look into all the YouTube guys and a lot of these training courses, if the market is closing on a high, at the end of the day, it will open gap up. That used to be a trend about till 2 years back, till 1 year back, and now it has changed completely. It doesn't happen exactly like. In fact, more of the time it will actually open contra.
Yeah.
So that is a fundamental change that has happened. Now, how do we identify that with our set of indicators? Is something that we are trying to answer. And once we are able to answer, then still the things will work. It's just that we have to know when to cut it. What are the indicators that are showing to you that it could be basis OI, this could be basis let's say longer term momentum indicators, could be any of these things, which will show that it might not be wise to carry a position.
Okay.
Most of the
So
trading is always about what when to trade and when not to trade.
yes, right. So are you then saying that like going forward, all the new strategies will possibly perform better than the old, like 1 year, 2 year old positional strategies that have been coded maybe on the basis of the market of those times?
This
Because
is
like
what
GMT
seems
is,
to be
I
the
think,
case
now
right
one and
now.
a half years old now. So that is what
That
I
is
was
what
asking.
seems to be the case right now. Doesn't mean that the current. So I'll put it this way: if you have a breakout strategy, it will work like a breakout strategy only. But the filters that we are using, those filters will need to be updated.
Right. So that it becomes even more advanced in getting to know if this breakout is true or not.
Exactly. So that's the only thing that is going to change.
Okay. So the core remains the same.
Yeah.
Oh, okay. Thank you.
Yeah. Anyone else?
No, Vishal, Praveen here.
Hi, Praveen.
Hi, Vishal. Just one question. We discuss about this new regime and the changes. So, what do you think that going forward, either positional or the intraday, which should be our major chunk should go into?
Very interesting point here. What should be more? I think it'll all depend upon your risk reward and the number of trades. Eventually, Praveen, you can't take away the comfort from intraday for a lot of people. Someone is comfortable with intraday, they will continue to be doing intraday. It's just a matter that when you're doing positional strategies, should you get positional strategies which are, let's say, very volatile, or you would get into a positional strategy which is less volatile? I think people want to have the less volatile strategy, and that is where what we are trying to do: have positional strategies which are less volatile. It might require larger capital and might miss out some of the trends, but it should be much more stable over a longer period of time.
Right.
So that's the
See,
intention.
at moment we have three type of position, right? One, simply take in the evening a straddle or strangle, whatever they want, and in the morning they close it. That is, in my opinion, no strategy. It's just a theta decay they want. Then we come across weekly, and then we come across monthly positional. And at moment, in one sound, everybody says 30% positional is a ideal for any portfolio. We should not go more than that. So, what do you think? Going forward, also 30% positional is intact, or someone should need to mix and match in other way?
No, I think positions should remain still 30%. It will not change the basic structure of the market. What we are trying to just do is things that work better is what we are trying to put in. The moment you put in positional at 100%, one black swan will actually take away your entire capital.
Because what I understood, most of people want to reduce their trade, which you also agreed in your presentation, that trade should be less. And there is a very simple opinion that in positionals, trades get reduced to even half or even less than that sometime in some strategies. Like for intraday, if trades are 200, then in positionals, it can come down to 100 also. So they want to save their cost there. And for weekly positional, they have more cushion here and there to go and adjust with the market conditions. So these are the new points and the new thoughts coming out when we discuss between traders. So that's why I asked Simon, what do you think about that?
Praveen, so if it's a positional strategy, which is more like a calendar spread, right? That you can deploy, more capital on, because with low VIX, it works quite well. But if it is a positional straddle or even a positional strangle, or if a positional spread as well, that's something that I would want to avoid. When you say iron fly or iron condor, iron fly is nothing but a straddle with a close by hedge, or condor is nothing but a strangle with a close by hedge.
Right.
If it is a calendar spread, that's a different thing. Then you can give more. That calendar spreads comes into category of arbitrage, in one sense.
Right.
And arbitrage is generally less risky.
Correct.
So that might work better. But if you look into traditional iron condor, iron fly and everything, not more than 30%. Again, I'll recommend the same thing. The moment arbitrage comes in, then you can allocate 20% to arbitrage, 30% to positional, and then 50% to intraday. That's something that you can do.
Okay. Yeah, fair enough. Thank you.
Welcome. Anyone else? Just need to raise your hands and I'll allow you to speak. Udit, you wanted to say something?
Nope, all good.
Okay. So if you guys don't have any further questions, I will end this call. We'll be putting up this recording on YouTube, and you can have access to this presentation there as well. In addition, we will we'll be taking questions from people who want to talk about Finvicia in about half an hour. So you want to have any question about Finvicia issue, you can join us after half an hour. Thank you, everyone. Have a good day. Bye.